It includes fiscal instruments, both taxation and spending. Crucially, emissions are a global externality, and decisive global action is long overdue. Leadership by major players, including China, India, the United States, the African Union, and the European Union, would be a game changer. Thank you for your attention. My colleagues and I are ready to answer the questions that you may have.
Thank you, Vitor. I think most of you know the drill, but let me just remind you a couple of ground rules. So if you want to ask a question, raise your hand. A colleague will come and give you the mic when I call you. When you take the floor, please let us know which network you're from. And for the colleagues who are joining us online, please let my colleague Mayada when you want to get the floor, and I'll try to alternate between the room and people online. I just want to start by one or two questions that I got in advance from people when we asked with the media advisory, and then I'll take more. I think I had Maoling who sent one. Maoling in the front row there. She's right there.
Thank you, Nico, for taking my question. I'm Maoling Shou with Xinhua News Agency. So, Vitor, you talked about the high public debt levels and the debt to GDP ratio is higher than pre-pandemic levels. And you also mentioned higher interest rates. Higher interest rates have pushed up the cost of debt servicing cost and the restraining fiscal space. Can you elaborate a little about how big the pressure is for governments, especially for lower income countries? And also on China, some argue that China, we need more fiscal support to support economic growth. But the IMF has also pointed out China's high debt levels. Do you consider there is still fiscal space for the Chinese policymakers to boost its economy? Thank you.
Thank you, Marlene. Vitor, I also had a question from the colleagues on the second row from AFP, who I think was very similar to Marlene. So, Erwan, you want to?
Good morning, Vitor. Erwan Lucas from AFP. So, yeah, my question was also about rates. We've seen that inflation here is a bit sticky. It might push the Fed to reconsider first cut rates this year, perhaps a bit later. It might be the same also in the UCB for the Eurozone. What might be the consequences of higher rates for emerging and developing countries, and specifically those who are already in debt distress or near debt distress? Thank you very much.
So thanks a lot. Important question. What we do see, and we have in our baseline, is that interest rates have increased relative to the recent past. They have increased in order to fight inflation, but long-term interest rates have increased as well, and they have increased significantly more than what was projected at the time, well, pre-pandemic. And that puts pressure on governments because spending increases given the higher interest bill. At the same time, we emphasize in the Fiscal Monitor that interest rates are volatile, and they're much more volatile than growth rates. So it's very important when thinking about public finance management to take into account that the cost of funding, the availability of funding may fluctuate in a way that can be sudden and unexpected in some cases. When we look at the extreme case of low-income developing countries, what we do see is that these countries were not able to extend fiscal support in response to the pandemic crisis and the cost of living crisis to the extent that was possible in advanced economies, for example. Pierre-Olivier Gourinchas, the chief economist of the IMF, did stress that our estimates of scarring have been revised down for most country groups, but unfortunately not for low-income developing countries. In the last 6 months, in the period since Marrakesh, we have seen that sovereign bond spreads have generally trended down, and we have seen a number of countries from sub-Saharan Africa issuing bonds in international markets in the early years. But the constraints on public finance are particularly severe for this group of countries, and the spending pressures to tackle issues like, in many countries, poverty, hunger, need for infrastructure, investment in people associated with strong growth of population and very young populations is clearly putting pressure and stressing public finances in these countries, and high and volatile interest rate makes the situation worse. Shall I address the question on China, Nico?
Yeah, please go ahead.
So when looking at China, we see that China, together with the United States, is extremely important for global public debt trends. In the United States, in our projections, debt is increasing about 2 percentage points of GDP per year. In China, the path of increase is even steeper. So clearly, issues that have to do with long-run sustainability of public debt in China are important. In our view, China does have policy space, and China has a number of options that it can exercise to control deficits and debt. But if I were to give you my 3 top challenges for China and China fiscal policy right now, the tackling of the debt path would not be in the top 3, because it should be tackled in the context of a comprehensive strategy. What is important in the comprehensive strategy? One, I would very much agree with the Chinese authorities when they put their emphasis on innovation and productivity growth. That is a topic which is very central to the analytical chapter in the Fiscal Monitor. The second priority that I would stress is the need for China to, as quickly as possible, solve the property crisis and the impact of the property crisis on the public finances of some subnational entities. And third, and also important, China is facing lack of aggregate demand. Deflation in China is a risk. And by taking fiscal measures that support spending by households, for example, by strengthening social safety nets, China will be able to sustain the adjustment to a new growth model at the same time that it contributes to macroeconomic stability right now.
Thank you, Vitor. So I'll take one more in the room before going online. I like to reward the good students who sit in the front, so I'll start with you.
Thank you very much for the opportunity. My name is Jason. I'm from Tencent News from China. So my question is regarding the U.S. fiscal situation. So in today's report, it has raised this concern about U.S. fiscal deficit in 2023. So with the general government fiscal deficit rising to 8.8% of GDP from 4.1% in 2022, despite strong growth. And also found out yesterday's WEO report also basically echoed today's report, warned that the rates of short-term risk to the disinflation process, as well as the long-term effect, and also the risk to the global economy, since it risks pushing up the global funding costs. So can you elaborate how the U.S. fiscal risk can affect not only the U.S. economy and also the spillover effect to other economies do you think that U.S. government should be, more responsible when, considering issuing more and more debts? Thank you.
Let me just, anyone else has a question on the US? Yeah, okay. The lady on the third floor there, on the third row, sorry, not third floor, fourth row.
Hi, Andrea Shalal with Reuters. I wanted to ask, the President is going to announce today a call for increased subsidies on steel. I know that you've raised concerns about that kind of measure in the past, and I wonder if you could comment on that. But then separately, I wanted to ask about the issue of taxation. You're calling for countries to do more to mobilize revenues, and there's a growing movement to tax the super rich. You talk a little bit about excess corporate profits, but can you just talk about whether those options would produce sufficient revenue for especially developing countries?
Thank you, Andrea.
Thank you.
So I believe US is Vitor and there are taxation and industrial policy. Okay, go ahead, Vitor.
So thanks for the questions on the US. When it comes to fiscal policy in the US right now, I like to start the story with the very strong turning point in US fiscal policy in 2023. In 2022, the US was well on track to normalize fiscal policy after the pandemic. And my favorite indicator of fiscal stance, which is the cyclically adjusted primary deficit, was at 1.9% of GDP that year. In 2023, it was multiplied by almost 3 to reach 5.6% of GDP. And going forward, the primary deficit in the United States will stay in the range of 3 point something and only comes below 3 towards the end of our projection period. That leads to a situation where that is increasing at about 2 percentage points of GDP per year. We have emphasized many times that this fiscal policy puts pressure on policy rates, it puts pressure on long-term rates, it affects costs of funding everywhere in the world. And if the stance of policy in the United States is also uncertain, there is also an element of risk, which is reflected in the pricing. These phenomena are well documented in the Fiscal Monitor, and the spillovers are quantified in a variety of ways. Our view about the United States, as about China, is that the authorities have a number of options that they can use to put this situation under control. And the way it will be done will be the outcome of the political process in the United States, which is RSQ to cover issues of trade and industrial policy.
Okay. Thanks. So we're of the view that maintaining open trade is actually vital to the U.S.'s economic performance. As you know, Andrea, in our Fiscal Monitor chapter, we showed that even large countries, large advanced economies, tend to rely on innovation that is done elsewhere. So we are of the view that this is important for U.S.'s economic performance. And as we've said before, including in the most recent Article 4 for the U.S., we believe that the U.S. should actively engage with all major trading partners to address the core issues that risk fragmenting the global international trading system. And as the managing director herself mentioned in her curtain raiser speech, we advocate for open trade and cross-border investment flows, because this is important also for global productivity and for global growth.
Thank you. I would like to now move to WebEx.
I want to answer the question on taxation.
Okay.
So the issue that you raise, Andrea, is a very topical issue. There is a lot of concern about fair distribution of the tax burden, and there is particular concern about the concentration of wealth and income at the top of the distribution. In that context, many times one hears calls for taxation targeting the super rich. One sees calls for wealth taxation. Our position at the fund is that taxing the returns from wealth is generally less distorting and more equitable than a wealth tax. Put in other words, there is no objective in terms of fairness that you cannot serve, given what we have now in the world, better by adapting the income tax system. We very much emphasize the importance of international cooperation. For example, in exchanging information to make tax avoidance and tax evasion harder. We do believe that international agreements, like what was possible in the OECD inclusive framework for corporate income taxation, is a very important asset, and we believe that countries and tax administrations should embrace the promise of technology to adapt the tax system and reinforce tax compliance.
Thank you. Okay, so I'll move online. I think I have Anya from Lusa and Godfrey, if I can take you both now. Turn on your camera. Anya, please go.
Hello, good morning. I would like to ask you, what are the main challenges for governments to normalize budgetary policy after the debt legacy of recent years? Thank you.
Thank you. Could we also get Godfrey on now? Is Godfrey available?
Vitor, a couple of questions from me. So here in South Africa, the country will be going to the polls on the 29th of May, one of a large number of countries that are holding elections this year. But we struggle with perhaps challenges that are slightly different to others. We're talking slow growth, and we're talking very, very stubborn inflation. So I wanted to know from the fund's perspective, what kind of advice you're suggesting that governments pursue in respect to fiscal policy to try to build the fiscal barriers that you are saying are necessary in this environment. The second question is around the sub-Saharan African region. We do have pockets of growth, but there's the real risk of fiscal slippage across many countries in the region because of high debt. We also have the elections that you were talking about and the attendant pressure to spend, and added to that is the geopolitical fragmentation picture. Are you seeing any evidence of this beginning to affect government's ability to implement effective fiscal policy? And what kind of policy options are you giving to governments to prevent a backsliding on this? Thank you.
Okay, I'd like to bring, I had two people in the room who also sent me questions on Sub-Saharan Africa. I'll try to bring them in because the answer may be similar. I think Kemi, so the lady in the fourth floor there.
Thank you. Good morning. Thank you for taking my question. Kemi Oshikoya from the Africa Bazaar magazine. My question relates to some of what they've asked regarding taxation. You've talked a lot about mobilizing revenue in Africa, in particular, through taxation. And this is something that has been very difficult for government to do. So in your assessment, when you look at the region, what are some of the tax and social policy that are working that we boost, regarding the fiscal policy that you think governments can emulate and also improve on? Thank you.
Thank you, Kim. If I could maybe also take the gentleman then in the second floor with the red tie and the other gentleman there. Yeah, maybe start it easier.
All right. My name is Edward Nyakon from Ghana Broadcasting Corporation. In 2023, your report indicated that fiscal policy should prioritize consistency with monetary policy to restore price and financial stability while supporting the most vulnerable. If you look at what is happening in Africa, especially countries like Ghana, where we're having debt challenge, some are calling for a review or reform of the common debt framework. In your assessment, this year, we're going to elections, including other African countries. What government should do whilst this framework is delaying, which is also affecting government ability to mobilize funds and to restore macroeconomic stability? What should they do to be able to ensure that we don't go through the slippages we do experience during election period?
Okay, and I promise to the group on this side, I'm coming to you next. Yeah,
Thank you. Simon Ateba with Today News Africa in Washington, D.C. I know you've been asked a couple of questions about Africa. I should stand. Okay, so I'm sorry. More broadly speaking, how does the IMF assess the effectiveness of fiscal policies in addressing the unique economic challenges faced by various regions in Africa? And what strategies are recommended to optimize fiscal policies' impact across the continent? And lastly, in light of the evolving global economic dynamics and regional disparities, what key adjustment and innovation does the IMF foresee in fiscal policy frameworks to foster sustainable growth, stability, and resilience in African economies over the coming decade? Thank you.
Thank you. So, Vitor, you want to take the question from Anya, and then I can move to Marcos for Sub-Saharan Africa and Era for South Africa.
Thank you so much. So our main message in the Fiscal Monitor on fiscal policy is that time is right now to engage in fiscal normalization, and that is because the world economy has proven very resilient. Inflation is coming down. Risks are now balanced. And so, almost everywhere, it's very important for authorities to stay the course, to control public debt developments, to moderate public finance risks, and to build buffers to be able to withstand future shocks. What are the obstacles? I will leave politics aside, because we got a number of questions specific for African countries. So I guess that Marcos will be covering that specifically. But I think it's very important to remind everybody that one of the findings from a book, Fiscal Politics, from 7 years ago, was that countries that have strong fiscal frameworks, that use fiscal rules, that rely on institutions to ensure fiscal transparency, have much smaller fiscal slippages in election years. So with institutions, it has been possible to control the temptation for incumbent governments to use fiscal policy for political gain. And I believe that is extremely important. I don't know if Marcos or Era.
No. Maybe I'll turn to Godfrey's question on South Africa first. So Godfrey, when we look at South Africa, we see that fiscal deficits and debt levels are projected to remain high over the medium term. The fiscal deficit was about 6% of GDP in 2023. It's expected to remain more or less the same next year and gradually decline to 5.5% over the medium term. In terms of debt levels, debt to GDP ratio is expected to reach almost 86% by 2029, which is 12 percentage points higher than in 2022. So our general sort of advice that strong fiscal consolidation is needed to create budgetary room for maneuver and to bring debt down remains relevant for South Africa. And in terms of sort of more concrete, specific recommendations, we believe more decisive efforts are needed to cut spending. And this can be done by reducing transfers to state-owned enterprises, rationalizing untargeted subsidies while protecting public investment and protecting well-targeted social assistance for vulnerable populations. South Africa has a good fiscal rule, complementing this with additional targets, for instance, a debt ceiling could be useful. Improving expenditure efficiency through improvements in procurement and public investment management would also help public finances. In addition, we believe that very ambitious structural reforms are really urgently needed at this stage to bolster growth. The immediate priority for South Africa is to resolve the energy and logistics crisis, and further reforms in product markets and labor markets and governance could actually bolster productivity and improve growth prospects, which will also be good for public finances.
Thank you, Ada. So just to give some numbers before going to policies in Sub-Saharan Africa. In fact, Sub-Saharan Africa this year, in 2023, had like a decline in the overall fiscal deficit. So the overall fiscal deficit in 2023 was 4% of GDP compared to 5.2% of GDP in 2022. It is projected to continue declining to 3.6% in 2024, reaching 2.7% of GDP by 2029. So that will bring debt levels in the region down from 55% in 2023 to close to 44% by the medium term in 2029. Now, clearly, there are risks to this baseline that we just mentioned, and I think some of the risks we have already mentioned. Some of the countries that have elections this year are located in Sub-Saharan Africa, and our chapter discusses, the risks of fiscal slippage in countries with election in an election year. In terms of policies, we advise countries in Sub-Saharan Africa to increase their revenue potential. So our chapter has a box 3, discussing the revenue potential. Our department has launched a staff discussion note recently on how emerging markets and developing economies could raise revenue potential. And the main instrument is through broadening the tax base. We believe that broadening the tax base could be one way to increase revenues, including in the region. It's important as well, as been mentioned in the questions, to improve and modernize public financial management systems. And by that, the implementation of fiscal rules, as Vitor said, or credible medium-term frameworks, that's something that countries in the region could implement in the coming years to improve their conduction of fiscal policy. The fund is also contributing through capacity development. The fund is also contributing through IMF arrangements and through international cooperation on that restructuring. Now, moving to Ghana, Ghana is one example of how this fiscal consolidation is on the way. They have done a strong revenue mobilization in recent years and also controlled expenditure.
Thank you. I promised I was going to go back there. I see that we only have 15 minutes left, so let's do a bit of Fiscal Monitor speed dating. I see I have a UK corner there, so let me take all the UK questions at the same time. Larry, Elliot.
Yeah, Larry Elliott of The Guardian. The UK is one of the countries that has an election looming this year. Is the fund suggesting that fiscal policy in the UK should be loosened or tightened?
Oh, thank you, Larry. Short and sweet.
Alex Brummer, the Daily Mail from the UK. You make reference in the Fiscal Monitor to the UK and the recent tax cut in the UK, the reduction in national insurance contributions. It wasn't clear whether you actually approved of that or didn't approve of it, and I just wondered what your thinking was.
Okay, thank you. Anything else on the UK? Nope. So any more questions on this side of the room? I didn't see any hands raised. No. So I'll go to the lady in the front row in green. And yeah.
Thank you for taking my question. Laman Zeynalova from Azerbaijan-based Trend News Agency. My question is about the finding balance between the fiscal tightening and climate change, because as far as I understood, IMF recommends to predicts fiscal tightening measures. So how would IMF then recommend to find a balance between fiscal tightening measures and financing climate change, including financing, investing in green technologies, also adaptation to climate change, mitigating climate change, and while maintaining the financial sustainability? Thank you.
Thank you. Could I take the other lady in front row and then this one?
Olena Krajdan, Ukraine's The Page media outlet. I have a question regarding emerging economies, and previously it was said that they will become a driver of the future growth since the advanced economies grow at a lower pace. But this sector is very broad, and if we exclude China, China has its own situation. We have many countries, Europe, Asia, all of them have different situations. Is it possible to form some fiscal policy cornerstones for them in the future, if it's possible?
Thank you. And then there's Stefania on the fourth floor.
Thank you for taking my question. Stefania Spatti from Class CNBC. In the Fiscal Monitor, you mentioned Italy as one of the largest economies that are contributing to increasing the debt to close to 100% by 2029. And I was wondering if you think that the government is too optimistic about its debt trajectory, considering that your estimates are worse. And as a follow-up question, why have you chosen Italy in figure 1.20 as an example of a country that needs to do more on a fiscal front in the next couple of years? And therefore, what is your policy recommendation and what are these efforts in numbers?
Thank you. So I believe UK, Italy is for you, Vitor. Two other questions from you, Era. Colleagues online, I'm going to go for last round on WebEx after that, so stand ready.
Okay, so let me take the UK first, then we will go to emerging markets with ERA, and I will come back to Italy at the end. The UK is a country that is characterized by relatively high debt. The UK has had low growth for a number of years, and the growth has been particularly lackluster in recent past, and the World Economic Outlook has revised the UK down. Higher real interest rates and lower medium-term growth prospects are common with other advanced economies, and that's an issue that I have explored with my colleagues Pierre-Olivier Gourinchas and Tobias Adrian in a recent blog. The UK authorities are committed to fiscal consolidation, and they have been emphasizing since years the need to reduce inflation and stabilize debt. To bring debt down to sustainable levels does require taking into account the criticality of spending in important and priority public services, but also growth enhancing investments together with structural reforms to increase and improve potential growth. There are a variety of measures that UK authorities can take to improve the fiscal balance, both on the spending and on the revenue side. I would respectfully recommend that the forthcoming Article 4 consultation in May will provide an opportunity to discuss this and other issues more in depth and recommend the regional economic outlook that takes place by the European Department this week. Era?
Okay, thank you. So on your question on emerging market economies, there is a divergence at this juncture in terms of growth performance, as was pointed out in the World Economic Outlook. But there's 2 points that I'd like to make here. The first is that while there's a divergence that we see at the current juncture, from a longer-term perspective, we see that productivity growth has been declining also for emerging market economies. Right? So as a group, productivity growth has been declining structurally, and this is a long-standing trend. And what the risk that this creates is that the convergence gap between emerging market economies and advanced economies won't close as easily. So this gap could widen. Right? So what are the types of policies that are needed? In terms of the Fiscal Monitor, we talk about the importance of getting your fiscal house in order, absolutely critical in order to be able to pay for the needed public investments, in order to achieve sustainable development goals, in order to close convergence gaps. There are a host of structural reforms that countries need, which are country-specific. But in the Fiscal Monitor chapter, we also talk about one very important component, and that is innovation, and specifically technology adoption. Right? So for most emerging market and developing countries, technology diffusion or the adoption of innovation that is done elsewhere is absolutely critical in order to boost their own productivity growth and their longer-term growth prospects, as well as to build their own innovative capabilities. Right? And in here, in the face of the ongoing digital and green transformations that we see, there are a number of ingredients that we point out in the Fiscal Monitor. For example, if emerging market economies were to increase their spending on education by 1 percentage points of GDP, and this essentially closes the gap, the average gap with advanced economies, what this could do is that this would allow for a faster transfer of technology, adoption and assimilation of technology from abroad, and it could boost GDP by about 2% over the medium term, which is quite a sizable number, and so this can be an important way for them to close a sort of skills gap in the digital domain. We also talk about the importance of improving infrastructure quality. Now, to pay for these investments, as my colleague has already pointed out, countries will also need to look on the tax side of things, and mobilizing revenues in an efficient way can allow countries to pay for this productive investments.
Thank you, Hera. So Italy. Important, or Stefania won't be happy.
Okay, so to answer your question on Italy, why did we pick Italy? Italy is an advanced economy with a high public debt to GDP ratio. It is a country where there has been traditionally a concern about bond market developments and spreads. And perhaps I may have been even influenced by my own subjective experience, because I remember joining European committees back in 1989, and at the time the high debt level in Italy was already an issue. And for the record, the public debt to GDP ratio in Italy increased quite significantly since 1989. In our forecasts, we do have a situation where, as in many other advanced economies, the public debt to GDP ratio declined in Italy in 2021 and 2022. It continued declining until recently, but in 2024, it is projected to reach about 140% of GDP, and going forward, it is projected to continue rising to 145% of GDP at the end of our projection period. In recent years, Italy has actually recorded a relatively strong recovery, which together with the inflation surprise helped the decline in the public debt to GDP ratio that I've referred to. But going forward, the dynamics are not favorable, with economic growth projected to slow down and then recover, but remaining lackluster, at the same time that the effective cost of financing debt will go up. There are spending pressures in Italy, like in other countries associated with population aging, for example, but also the need for priority investments in green technology and digital and information technology. And our policy recommendation to Italy is that it would be important to have a credible and front-loaded fiscal adjustment to put the public debt on a sustainable declining path.
There's a question on climate.
Yeah, you want to take it?
Yeah, I could take it. So maybe just very briefly on your question on climate, in the October 2023 Fiscal Monitor, we talked about a fundamental trilemma that countries face when it comes to tackling climate change. If you were to rely on subsidies or just spending alone to tackle it, it's going to be fiscally very costly and could add to debt pressures. Not doing anything is not an option, because that means global warming with really deleterious effects on lives, on livelihoods and economies. At the same time, if you were to use carbon pricing as a way to sort of meet climate commitments, that could cross political red lines. So somehow we need a package of measures that allows countries to get around this trilemma. And we feel that carbon pricing should be an integral part of any policy mix, because this can allow countries to raise the revenues that are needed for green investments, but this should be complemented with a suite of other regulatory and other measures in order to incentivize firms and households to decarbonize.
Thank you. I'm going to get into trouble, but I want to take because we're over time, but I want to take the two last questions on WebEx, because one of them, it's really early for him, and the other one's really late, and they made the effort. Could I get Marcelo first, and then Doha, and then I'm sorry, I will have to close. Marcelo.
Hello, everyone. Thank you for taking my question. I would like to comment on the news that the Brazilian government has weakened its 2025 fiscal target from a 0.5 surplus to a balanced budget on the back of increasing fiscal spending, and also postponed its objective to return to primary surpluses to 2026.
Thank you. Doha? You are... Okay, we can't hear you. Wait a second. I think they're putting you on.
Can you hear me?
Yeah, go ahead now.
Okay. Thank you so much for taking my questions, Nicola. Good morning, everyone. I have a couple of questions on Egypt particularly. The first one is concerning the debt level. As you know, Egypt is currently engaging in a loan program with the IMF that has been recently expanded to $8 billion from $3 billion. So my question is on the debt level in Egypt. What are the projections of the IMF regarding the debt level in the country in the current fiscal year and the upcoming fiscal year? And what are the recommendations of the fund under the loan program to tackle the debt path, as well as raise the potential of the country's revenues? My second one is on deficit. We need to know the IMF's projections about the deficit and to what extent Egypt is able to achieve its target regarding its deficit till 2026. Thank you so much.
Thank you, Naha. So I would suggest that, Era, you answer first on Egypt, then I give Vitor on Brazil, and Vitor, if you can use that also to give any concluding words that you may want to. Okay. Thank you.
Okay, so thank you very much, Daha, for your questions on Egypt. So external debt in Egypt is projected to rise this fiscal year relative to the previous fiscal year. And this is largely because of valuation adjustments rising from the exchange rate depreciation following the unification of the exchange rate. But we expect external debt and overall debt to start declining from the next fiscal year onwards. In terms of the fiscal deficits, the budget for fiscal year 23-24 targets a primary surplus of 2.5% of GDP. Including 50% of divestment proceeds to reduce public debt. And for 24-25, the approved budget increased the primary surplus target to 3.5% of GDP. But let me just say that more generally, the economic strategy under the fund program is really focused on reducing Egypt's debt by putting the general government debt as a share of GDP on a downward path. And this is expected to be achieved through continued fiscal discipline while ensuring adequate social protection spending for vulnerable groups and the use of divestment proceeds. And more revenue mobilization will be also central to help support this effort, as will create the space that is needed for priority spending and for the targeted support that is needed for vulnerable groups.
Thanks, Marcelo, for your question on Brazil. After 2 years of cyclically adjusted primary surplus in 2021 and 2022, Brazil fiscal policy turned pro-cyclical with a deficit of 2.2% of GDP in 2023. Brazil's public debt is projected to increase from around 85% of GDP in 2023 to 94% in 2029, the end of our projection period. The authorities' fiscal consolidation path aims for an improvement in the fiscal policy position over the medium term, but uncertainty around fiscal consolidation going forward remains. High debt and uncertain costs of financing call in Brazil, like elsewhere, for prudent fiscal policy and debt management. Firmly placing Brazil on a public debt downward path would require a more ambitious and sustained fiscal efforts. If efforts should be anchored in an enhanced fiscal framework that builds on the new fiscal rule in Brazil while protecting social priority spending and investment spending. I will now make my transition to the concluding of this press conference with a number of key messages that I would like to highlight. There are 4 messages. The first, you heard it at the beginning, with the world economy resilient and risks to the outlook balanced, the time is right for countries to stay the course of fiscal normalization, build buffers to cope with future shocks, and to bring down debt to more sustainable levels. 2, with the pandemic a distant memory and inflation approaching targets, policies are no longer dominated by response to common shocks, and divergences across countries are taking central stage. That means that policies in general, fiscal policy in particular, have to be adapted to country-specific circumstances. Third, focusing on fiscal policy in this environment is appropriate because fiscal policy has an ample toolbox that is crucial for this adaptation to country-specific circumstances. I would like to emphasize the importance of long-term priorities like competitiveness, growth, productivity, and I heard a lot about climate in this press brief. Finally, countries must embrace international cooperation to address the multiple and pressing global challenges. And if you indulge with me, if I were to pick one, I would underline the urgency of climate action. Thank you so much for your attention.
Thank you, Vitor. Thank you, Era and Marcos, for being there with us. Thank you to all of you in the room and online. And my apologies for the crew in the room that were 15 minutes over time. For those of you who have not been able to take your question, you can try to find me afterwards. We may be able to answer to you in writing. You can find for more information on the website. But also just a reminder that the managing director is having a press briefing tomorrow at 8 a.m. Same as today, there'll be a lot of questions, so if you want to ask something, maybe let us know in advance. There's also going to be a regional press briefing tomorrow and Friday if you want to ask more country-specific questions. With that, thanks to all of you, and see you in 6 months.